Good morning. All right, a little bit of a longer video this morning. There's lots to talk about. It's been a pretty amazing month. But we're first going to talk about the Bank of Canada. So the Bank of Canada raised rates by 0.5% this morning. It's a big move. It's been a while since they've made a move like that. If you're in a variable rate mortgage or if you're in a line of credit, your rate's going to go up by 0.5%. On the fixed rate side, though, which is what we're going to start talking about, I mean, the last move has seen the biggest move in fixed rates in over 30 years. Fixed rates now, most lenders' 5-year fixed rate is above 4%. That's a massive jump. 6 months ago, fixed rates were around 1.5% to 2% below that in 6 months. That's a huge, huge increase. Fixed rates seem to have all the worst for inflation expectations and rate hike expectations priced in. But remember, if you're in a fixed rate right now, this rate hike talk doesn't have a direct impact on your mortgage right now. You're locked in, your payments are locked in. What I would suggest is starting to think about what's going to happen at renewal. If rates are higher than what you currently have, you're going to see a jump to your payment. There's lots you can do to prepare for that. If you want to talk strategies, get in touch with me. I've got lots of tricks that we can kind of go over that'll help you pay down your mortgage quicker and get you used to higher payments in the future. If you're in a variable rate mortgage, okay, your rate is going to go up, but keep in mind, you are still saving a significant amount versus locking into a fixed. If you're going to lock into a fixed rate today, you're locking into a rate that's, depending on your variable rate, around 1.5% higher than you currently have. Do you really want to be doing that? I mean, if you're in a variable, there's no guarantee we're going to get that many rate increases. I would be shocked if we get another 1.5% rate increases from here. And it would take that much just to get the variable to the same level as your fixed rate, but you've saved money the whole way up. And then for the variable to become more expensive, it would have to continue raising from there and stay there. I think that's a really, really unlikely scenario. And yeah, it never feels good being in a variable as rates going up, but we kind of knew rates were going to start going up this year. It's all happening a lot quicker than I think many anticipated. So that covers interest rates. Let's talk about inflation. Inflation is something I've been talking about since the pandemic first hit. Our economy got basically flooded with money, record low borrowing costs. Of course, inflation was going to pick up. I mean, you have the same number of dollars chasing a fixed number of goods. That means prices are going to go up. But keep in mind, inflation is a backward-looking measure. It tells us what happened, not what is going to happen in the future. Prices have been accelerating for the last year. While central banks were telling us that, it's transitory, it's not going to be an issue, it's supply chain disruption related, and our intention is to let inflation run hot. Well, guess what? Inflation has run hot, and now central banks are looking to raise rates kind of late in the game. They should have been doing that throughout last year. But the question right now is inflation going to continue to stay hot? Well, keep in mind, inflation is a rate of change measure, meaning the base effects matter. And it was in March of last year where inflation started coming off that 0 to 1% range into the 3% range and climbing from there. So for inflation to continue to accelerate from here, for the inflation prints to stay high around 6% moving forward, it's going to be a really steep hurdle for that to happen because of the higher base effects of last year. So I think a natural progression here is that we're going to start to see disinflation as we get into the year due to that higher base effects measure. I mean, for inflation to continue accelerating, we would need the price of oil to stay above $150 a barrel. It would need to stay there. Oil's already dropped 20%. It's around $100 a barrel from the high we saw over the last month. The other piece to think about here is demand destruction. With fixed rates over 4%, with a 0.75% jump to variable rate mortgages, that's going to have an impact on housing demand. In fact, it's already looking like the real estate market in Canada peaked last month. Not talking about local markets or Vancouver specifically, but across all of Canada. That's because of higher borrowing costs. I mean, we're seeing gas and energy prices have really gone up. I mean, when consumers are spending more of their paychecks on interest payments, on gas, on energy prices, on food, that takes away the potential dollars that can go towards renovating their home, buying another car, going on a vacation. In a lot of ways, kind of what's happening with prices, what's happened with the bond market, with yields and rates going up, is doing the Bank of Canada's work for them and cooling things down, providing a headwind that the economy is going to run into. So inflation tells us about the past. what do the forward-looking indicators tell us about what we can expect in the future here? I mean, all signs are pointing to a recession looming, to central banks tightening rates, tightening lending conditions, and raising rates late in the cycle into an already forming slowdown. I mean, it's a recipe for recession. In the US, a really famously reliable indicator, which is the 10-year and 2-year bond yield spread, that inverted, which meant that the 10-year yield went lower than the 2-year yield. Normally, the yields go up the longer the duration when there's growth. What that tells us is, central banks are going to raise rates in the short term. It's going to break things, and there's going to be a recession because there's lower growth forecasted in the future. Personally, I would be shocked if, in Canada, the Bank of Canada is able to raise rates by, another 1% from here without that causing a recession by the end of the year. Consumer cyclical stocks are down 20%. The transport new orders index has seen an extraordinary drop in new orders. China's PMI went from 50 to 42 as they're dealing with lockdowns. I mean, all these things suggest to a big slowdown ahead. So keep that in mind. You're in a variable rate, never feels good as rates go up, but you got to keep in mind you're still saving money versus being in a fixed. If you want to get defensive, lock into a fixed, you're realizing all those potential rate increases now. And you're locking into that rate. There's no guarantee you will get that. And if you're in a variable, rates are going to go up this year, but ultimately long term, they are going to start coming back down. And if you wanted to lock in and just get into a fixed rate, there's going to be a better opportunity to do that in the future. So happy to talk about all this. I know there's lots going on and there's a lot of uncertainty out there with mortgage rates, and this video is getting way too long than what I anticipated. But yeah, these are important things. I think it's worth staying the course if you're in a variable, but if you do want to look at locking in options, get in touch with me and we can kind of go over some numbers then. Thanks for watching. Have a great day.